Hello and welcome to our webinar, T+1 Ready to Hit a Home Run. In our previous webinar back in October, we covered the impact that T+1 will have on custody operations. In today's webinar, we will look at the final push towards T+1 in North America, and this will include an update on the testing in the US and the latest news from both Canada and Mexico. Our panel of experts will share with you how BNP Paribas is positioned to support your operations in the new reality that will exist from May. This webinar is tailored for the buy side. We ran a similar session for the sell side. There will be plenty of time for questions after the formal part of this webinar, so please feel very welcome to submit questions to us, and we will certainly try and get to all of them in this webinar. And if we don't manage to do that, we'll get back to you with answers separately. So please feel very welcome to submit questions. So without further ado, let's kick off. And maybe I could begin with a question for Yann. And Yann is our product manager. So he's one of the busiest guys at BNP Paribas. He's a project manager keeping T+1 on track. So Yann, let's talk a bit about testing. Could you tell us how we've utilized the testing period? Where do we stand today? And are there any lessons learned from the testing that you would like to share with us?
Hi, Alan. It's good to be with you all today. We're now closing in on the end of DTC testing cycle 16 out of 21 biweekly cycles. DTC will keep the environment open to direct market participants until after the conversion date. BNP Paribas has completed 2 out of our 3-phase testing approach, and we're well into our final phase. In August 2023, for those of you who joined in the previous webinar, we started with our local US end-to-end functional testing, with an emphasis on operational efficiencies as a way to eliminate lifecycle frictions. We later expanded to global and external parties with non-US regions testing, including non-standard event, bank holidays and outages, new solutions implementations, and partnerships. In Q4 2023, we've opened up our test environment to clients. Here, we have seen limited interest outside of ad hoc scenario for clients who've made specific functional or operational changes. Our teams remain available to help clients with last-minute challenges and further increase their readiness today. For the last stretch, we've shifted our focus to the migration weekend. With the very recent publication of the DTC Transition Weekend Runbook, we're finalizing details of the conversion rollout plan and well engaged into the migration rehearsal execution. At the market level, BNP Paribas continues its engagement with industry peers and is an active member of the T1 Transition Weekend Working Group. In terms of lessons learned, one significant takeaway is that the work does not stop with T1 going live. Whether it is deploying additional affirmation models, counterbalancing the increase in fails, and continue our clients' education on the significance of trade date affirmation, BNP Paribas keeps a heightened focus on this industry evolution and stands ready to accompany clients well beyond May 2024.
Thank you. Thank you. That's very helpful. Can I turn to Emmanuelle? Emmanuelle is one of our custody experts working on T+1. And after our last webinar, we got lots of questions about the affirmation process. I know we've published a lot of material about it since then, but could you tell us just once more about how BNP manages the affirmation process?
Thank you, Alan, for the question. Indeed, the affirmation concept triggers a lot of questions as it is a unique US concept that is comparable to the matching in other markets, but it introduced a new mandatory aspect that the Securities and Exchange Commission launched in February 2023 and will come into effect in May 2024. So affirmation is not a new concept, and BNP Paribas, we already process the affirmation on behalf of our clients. What is new is the fact that affirmation becomes mandatory and the process will have to take place earlier in the lifetime settlement cycle due to the move to T+1. Consequently, DTCC, the central depository, moved the affirmation cutoff on trade date at 9 p.m. Eastern Time. And DTCC also recently announced a target of having 90% of the trade affirmed by 9 p.m. Hence, from day one, BNP Paribas will support all the affirmation models that exist in the market, which are either affirmation by the custodian or self-affirmation. In case of affirmation by the custodian, it can be done either using our own institutional trade suite ID, or we can use the client trade suite institutional ID. In case the client prefers to self-affirm their instruction, BNP Paribas will continue to act as a settlement agent and will take care of the settlement as soon as the affirmation will occur. The default model we are going to apply, in case we don't get different asks from the client, will be the affirmation via the usage of our own institutional trade suite ID. Having said that, it's worth highlighting that if our client or its investment manager is recognized as a registered investment advisor, there is a record-keeping requirement to be taken into consideration. For this specific case, using the Registered Investment Advisor Trade Suite ID is highly recommended. It will facilitate their new obligation to keep track of their allocation, confirmation, and affirmation with a date and a timestamp.
Thanks, Emmanuelle. That's very helpful. But could I ask you, is there anything that needs to be set up for this affirmation process to take place? Is there any particular action required of either our clients or ourselves?
Yes, sure. Whatever the client's choice of affirmation model, either self-affirmation or affirmation by BNP Paribas, what is very, very important is for the client to set up the new settlement standing instruction into the DTCC platform alert, which is the platform to store the SSI. Like this, the broker can enter in alert and download the client settlement standing instruction. The appropriate setup in alert is key for the affirmation process, as it is the tool where the SSI are stored, but it is also the tool where the affirmation party is set up. Consequently, appropriate settlement standing instruction in alert reduce mismatching and late affirmation. On our side, we will update the service level description, which will reflect the affirmation model chosen and all the related relevant information.
Okay, thank you. Can I turn to Silvia? Silvia is responsible for our global settlement capabilities. So Silvia, given the importance of affirming instructions by the DTCC cutoff, I guess we need our clients to send us their instructions as soon as possible. But what happens if they do not get them to us on time?
Yes, Alan, you're right. Timeliness in sending us the settlement instruction will be key. As announced via client update back in December 2023, our cutoff for receiving client instruction and affirm them by the market cutoff is 8 p.m. Eastern Time. Let me mention that those of you that are listening to these WebEx can have a look at a box which is in your screen, where you can find plenty of material related to T1. We have the client update that I just mentioned. We also uploaded the client update, which is specifically meant to describe the process for registered investment advisor. You will find articles on affirmation and plenty of other materials which are T+1 related. You can click on them, you can download, and you can then, read for your own knowledge to get an update across all the subjects that we manage throughout these intense months of work. As I was saying, timeliness is key. Our own cutoff is 8 p.m. Eastern Time. And in our WebEx back in October, we mentioned the importance for everybody in the chain to review their end-to-end processes, giving up manual actions as much as possible and pushing therefore on automation to cope with the new requirements. So we really hope that this message was well received, and as such, you're now ready to go. To answer the second part of your question, Alan, so what happens in case the affirmation doesn't happen by the market cutoff, so 9 p.m. Eastern Time? Well, there is no penalty concept for late affirmation, but we need to consider the additional costs that DTCC will apply. DTCC shared their fee schedule for affirmation happening after the 9 p.m. cutoff with two different windows. One that is the night window at T, and the other one which is in the day at T1. So as you can imagine, in case of high volumes and in case of affirmation happening late, these additional fees could make quite a big difference in terms of CSD costs. So we don't want to scare anyone. This is not a threat, but we really want to be transparent with you on this subject, which we believe is very much important for everybody, which might bring additional charges in the custody chain.
Thank you. So are we monitoring our clients' activity today? And if so, is there anything worth sharing today coming out of that?
Yes, absolutely, indeed. The priority since the very beginning was to help our client transition into T1. And with this aim, we started some months ago reaching out to clients, sharing data extracted from our settlement system to show their current timing for sending settlement instruction and how this could affect the affirmation rate when we switch to the new model from May 28 onwards. This is an exercise that we named affirmation boosting exercise. It is ongoing as we speak. It won't be stopping by May 28, so you can remain assured that we will continue even after the T1 go live to review numbers, to have ongoing checks with you for trying to enhance any situation which might show issues in affirmation happening late, always having in mind the additional costs at DTCC that we could decide in the future to pass on to clients.
Okay, now we're going to focus on some product solutions that are particularly relevant to clients transacting with a shortened settlement cycle. We've developed services to improve the straight-through processing of transactions from order creation to settlement. These reduce the potential of settlement failure and additional funding costs. One of these, called execution to custody, is of most interest to our banks and broker-dealer client base, so we're not going to cover it today, but do reach out to us if you would like to know more about it. In today's session, we're going to focus on what is of most interest to buy-side clients, asset owners and asset managers. So let's start with dealing services. Mikael is our business development manager for this product. So can you help us understand the value of this offer, Mikael?
Yes, thank you, Alan, and hi, everyone. So dealing services is a BNP Paribas outsourced trading offer. It sits on the buy side, as you mentioned, and serves primarily asset manager, asset owners, but also wealth managers. It comes as a package solution with our middle office transaction management service to deliver an execution to settlement STP solution in line with the T+1 standards. With T+1 in the US, all European and Asian participants must comply with these new deadlines during their night break. transactions are expected to be matched in CTM on T by 7 p.m. New York time and affirmation then in DTCC by 9 p.m. New York time. So before T+1, those participants could, while they had time to leverage internal operation teams to manage their post-trade process during their T+1 business hours. With T+1, they have to implement solution and manage this process during the night break in order to avoid market penalties. So dealing services with middle office help our client overcome night break in the processing chain. With dealing services, client also benefits from a dedicated buy-side trading desk with experienced dealers in all asset classes. It's a multi-broker access and custodian agnostic setup with 2 trading models, reception and transmission of orders, and match principal. It's also premium service offer with dedicated client service team and advanced features such as TCA reporting or dedicated in-house front end, to quote a few. Once the order is executed, it is automatically sent to post-trade, and our middle office teams take over the matching and settlement instruction on client's behalf to meet T+1 standards. So all in all, outsourcing, partially or fully, the execution and middle office transaction management function is a growing trend in the market. It allows clients to delegate the related operational risk to a leading provider like BNP Paribas and to benefit from a premium and flexible service offer that fits their exact needs.
Thank you. Could I turn to Diller now? Diller is a product manager in our middle office services business. In our previous webinar, and I think via client updates, we've covered the impact of a shortened settlement cycle in middle office transaction management and how we support our clients. So could you now tell us a bit about our product offer?
Yes, thank you, Alan, and hi, everyone. So first of all, I would like to highlight that we are offering a comprehensive in-house transaction management service delivered in the 3 regions, US, Europe, and APAC, to cover the full post-trade execution processing from trade capture to broker matching, settlement instruction, settlement monitoring, including penalties follow-up for CSDR eligible trades. The service also incorporates claims management and trade status reporting. We are ensuring our service fully complies with the regulations and the market practice evolutions. And we are currently heavily focusing on T+1 settlement cycle evolution in US, Canada, and Mexico to accompany our clients and have adapted our product offer as follows. We extended our trade capture cutoff to 6 p.m. US Eastern Time to ensure trades are matched by 7 p.m. US Eastern Time as per the DTCC market best practice. We expanded our support hours until 9 p.m. US Eastern Time to manage trade integration, matching, and settlement queries. We also developed daily reporting highlighting unmatched and mismatched trades in the US, Canada, and Mexico markets. And last but not least, we'll provide a regulatory reporting for registered investment advisors impacted by Rule 204-2 of the Advisors Act, including provision of allocation, confirmation, and affirmation date and timestamps.
Thank you. Let's move on to the FX implications of T+1. So Mirko, you work in this area. Can you please quickly recap its impact for our clients?
Yeah, hello, Alan, hello, everyone. Yes, let's start saying that we have recently seen bigger interest in this topic. That's also why we sent out some client communication and Q&A on that. So these are fully accessible already to our clients. The shift to T+1 is going to have a significant impact on the FX management for all the market participants. Giving you a concrete example, today the clients, they have 2 full days to run their processes, from the equity execution, post-trading, settlement, to generating, executing, and settling their FX transaction. With T+1, this time frame is clearly shorter, and for some, for example, the APAC ones, the window to execute the mentioned tasks can be even few hours, can be only few hours.
Okay, so what can clients do to make sure that the FX will be performed on time?
Sure. First, clients must review their FX operating model and assess risks. Processes then can still be managed internally, but the global and efficient structures or extending working hours may be needed. This can be easy to achieve for a global organization or costly for the ones that are not there yet. Otherwise, as also encouraged by DTCC, clients may ask for help from their custodian. And of course, we, as your custodian, are here to help you achieve a smooth transition to T+1.
Thank you. Can you please give us a quick overview of how we can support buy-side clients?
Yes, there are several benefits when security services is both the custodian and the FX counterparty. As a clients, our clients can reduce their risk by having a universal bank like BNP Paribas, managing entirely their FX trade lifecycle, from the execution creation to execution and settlement. As an example, let's imagine a portfolio manager buying a US assets. With our FX solution, we will immediately know how much USD is needed to fund their trades. We will execute the FX based on client preferences and parameters at a transparent and pre-agreed reference rate and spread. The reference rate can be market, fixing, or even algos. Then, thanks to our global presence, we can execute it around the clock and settle it by passing cutoff or even bank holidays. Yes, we can settle USD FX even if it's bank holiday for the non-USD currency. Clients do not even have to instruct payments. We take care of that too. Of course, this is not a completely blind process for our clients. They can monitor everything or even control all these steps in a state-of-the-art FX portal. So as you can see, why should the buy-side clients bear all the FX risks when they can be passed to a universal and solid bank like BNP Paribas? We, as your bank, can handle your cash management efficiently and around the clock with attractive, transparent, and competitive FX solution. I'll be happy to answer the audience question during the Q&A if needed. Thank you, Alan.
Thank you. So could I now turn to Isabel? Isabel works in our fund distribution business. European and APAC fund subscriptions and redemptions are often settled in T+2 or T+3. With the Americas moving to T+1, what can be the consequences for European and APAC funds investing in American assets?
Thank you, Alan, and hello to everyone. This move will create an increased mismatch between the settlement cycle for US security that the fund may invest in and the subscription redemption payment with the investors. The fund will have to manage the resulting liquidity issues and potential breaches of their investment ratio. Let's take an example. If there is a subscription placed on T requiring related investment by a fund into US equity, this equity will be bought on T and the fund will have to pay for those equities on T+1. However, the fund will only get paid by the investor on T+1 or even T+3. To address this evolution, the fund manager can consider two options or a combination of two options. Option 1 is to shorten its life cycle for subscription and redemption. Option 2 is to manage the impact on the fund asset side with a specific focus on liquidity. Focusing on the first option, from the investor point of view, the effective settlement timeline is between the reception of the contract note on T+1, where the NAV is published, and the expected value date. Shortening the fund life cycle will have a direct impact on fund distributors and the investor ability to pay the fund on expected value date. Changing it to T+1 is just not realistic. It would leave only a few hours in the European afternoon for the investors to manage the payment. Changing it to T+2 could be an option. However, it would impact the fund investor, particularly those active in APAC, and it will probably require the NAV to be published earlier on T+1. It will impacting all the actors contributing to this. As BNP Paribas, we stand ready to cooperate with your team to assess the potential reduced fund life cycle based on your current fund timeline.
So if we cannot fully align the fund life cycle for those funds, the fund will have to manage the increasing time gap between the fund asset settlement cycle and the fund subscription redemption cycle. How can BNP Paribas support asset managers coping with this?
Today, fund managers are already facing such situation actually. For subscription redemption the life cycle is T+2, or even in the majority of cases in Luxembourg, T+3. On the asset side, the settlement cycle is already T+0 for money market funds, money market instruments, T+1 or T+2 for bonds and equity markets. And for APAC assets, the investment is often made the day after the subscription, settling 2 days later. At BNP Paribas, with our MFS team, we stand ready to help you to find the right solution to manage the liquidity issues in line with the fund prospectus rules.
I understand that you've just been at the Luxembourg Fund Managers Conference. I think that was this week. Was there any new information that you can share with us?
Yes, there was indeed, Alan. We heard that CSSF, the Luxembourg regulator, will release a revised version of the circular dealing with NAV errors, including investment restriction breaches. Apparently, the circular will make a taxonomy of different breaches categories, qualifying their importance. A breach related to security settlement difference should fall with one of those categories, and its importance will be qualified accordingly. Regarding the more practical consequences of liquidity mismatch following the implementation of T+1, ALFI and CSSF are planning to issue a Q&A to guide asset managers through the impact and how to deal with it.
Thank you. Now, Silvia, in our previous webinar, and I think via client updates, we've discussed the SEC record-keeping requirements for registered investment advisors. Could you tell us what our custody product offer is for this?
Yes, Alan, thank you. So indeed, Rule 204-2 is for registered investment advisors that are parties to contract under Rule 15C6-2 to make and keep records of confirmation, allocation, and affirmation, each of those with the date and the timestamp. So indeed, it is very important to say that the usage of the Trade Suite ID number gives a significant benefit related to T+1 compliance, in particular when it comes to RIAs and record keeping. Why? This is because having your own Trade Suite ID, if you are an RIA, so a registered investment advisor, is highly recommended, since this allows you to have full visibility into when the broker submitted the ID confirm and whether the instruction was affirmed or not. Also, this allows you to maintain an archive of your Trade Suite ID confirmed product at DTCC. So if you are a registered investment advisor and you have a master service agreement with DTCC, we expect you to retrieve your records directly from the Trade Archive tool at DTCC. Of course, we are available in case the registered investment advisor doesn't have a master service agreement with DTCC to apply for the Trade Suite ID on behalf of our client. So this is the content of the client update that you just mentioned, Alan, and that any participant to this WebEx can find in the box that I was mentioning before. Of course, we remain available to provide affirmation on behalf of the RIA using the Registered Investment Advisor Trade Suite ID. This doesn't mean anyhow that non-registered investment institution don't have to request their own Trade Suite ID. So this possibility is also open. DTCC released plenty of documentation and Q&A saying that there is the possibility to request for an ID only, so a non-affirming ID that can be requested without the need of having a master service agreement with DTCC, and we as your custodian will take care of the affirmation process using your own institutional Trade Suite ID if this is the choice. And to conclude the answer to this question, as per the discussion that Diller just had with regards to global middle office clients. So if you are with us in custody and in middle office, reporting for registered investment advisor clients will be provided by our global middle office directly.
Okay, thank you. Let's go back to Yann. We've now talked quite extensively about T+1 in the US. So could you tell us a bit more about what is happening in Canada?
Absolutely. In Canada, the CDS industry testing started in January of 2024. Similar to the US, the market testing there is run on a 2-week cycle through April, and it focuses on direct market participants rather than clients. Throughout the summer 2023, the T1 regulatory framework in Canada has evolved and culminated in the publication of the amendments to National Instrument 24-101 in last December. One question we frequently receive from clients is there an affirmation process in Canada? You've heard it before from our panelists. The affirmation process is unique to the US. Instead, Canada has a matching cutoff. With NI 24-101, the new trade matching deadline will be 3:59 a.m. on the day after the trade T+1. The rule is a recommendation by the regulator, not a mandatory measure. Trade instructed after the defined timeline will still settle, but the executing broker will be questioned by the regulator and will need to provide reason for delay. In order to maximize matching, regulators also highlight the increased likelihood of fail for each instruction received past the 3:59 a.m. ET matching cutoff on T1. Additionally, and again echoing the US market, a broker-dealer's reputation would likely suffer from consistently matching late. Finally, all investors are expected to follow the NI 24-101 trade matching requirement no matter where they reside. With 1 day less, trade exceptions must be resolved prior to CDS market cutoff at 4 p.m. on T1 to avoid settlement fails. Although there are no penalties introduced by the ruling, regulators expect further settlement efficiency gains as a result of the shortened life cycle and reserve the right to introduce penalties at a later stage. The move to T1 in Canada is scheduled 1 day earlier than the US on May 27, 2024.
Okay, but what about Mexico? Can you give us an update on the latest news about Mexico?
Certainly. In July last year, the Mexican capital markets announced their intention to initiate the formal request for T1 for May 27, 2024. DJIVAH, the local CSD, has since hosted roundtables with direct market participants to assess the impacts of T+1 locally. With these consultations still ongoing, no major impacts or cutoff changes, including no announcement regarding any buy-in regime change, are expected. From an asset servicing perspective, Mexico is an omnibus market, and they've already confirmed that pay date and record date would go back 1 day, with the record date aligning to the X date. While the update to existing technology constitute a challenge for local market participants, the speed and automation of the matching process stand out as an area for possible improvement. Unlike the US, again, there is no affirmation requirement for trade settlement in Mexico. At the time of the webinar, and although I should point out that this is seen as a formality, the Mexican authorities had yet to approve the settlement cycle change from T2 to T1.
Thank you. So we hope that what we have presented today is helpful. We're now going to move on to the part of the webinar when we respond to your questions. So please do feel free to submit questions to us. We have a few. We've probably time for a few more. But just before we do so, can I say that as we move closer to the transition, we want to underline our enthusiasm to support you through this change. You are not alone. Our client servicing teams and product experts are at your disposal. They would be more than happy to go through any aspect of T+1 settlement with you. So do not hesitate to reach out to us. We will keep you up to date with any further developments. And as we get closer to the change, we will also keep you up to date with business as usual. So let me have a look at some of the questions coming in. So I think this first one is for Silvia. I think this is for you, Silvia. We hear a lot about T+1 discussions in the UK and in the EU. Could you tell us more about it?
Yes, thank you, Alan. Indeed, I must admit that in Europe and in UK, we are having lots of discussions around T1. In January, for instance, we heard a message from the European Commission stating that the question is not whether there should be a move to T1 in Europe, but when and how. I mean, as we can imagine, the statement has brought different reactions from the industry. The majority of international players stressed right away the importance for coordination between Europe, Switzerland, and UK in considering any T1 move for these countries. And we really believe that there is a strong rationale for alignment between Europe, Switzerland, and UK moves. But however, we are conscious of quite a few number of challenges that needs to be addressed and fixed before these happen. And all these challenges are linked to the fragmented structure of those markets, given the high number and the diversity of market infrastructure. So we have a lot of exchanges, CCPs, CSDs, as well as different national stakeholders. So we believe that ahead of any decision by the European public authorities, that will really be benefits to try and solve these challenges and to contribute to technical discussion requirements for any potential move to T1. We also know that ESMA has been tasked by the European co-legislators to produce a report on T1, covering its impacts, costs, benefit, for the aim of providing an overview of international developments that are requested. And we believe that this report should come out after the US move to consider the potential lesson learned. As such, the proposal that we support is to start with the preparation phase with the objective of identifying the precondition for the move, any changes to market infrastructure functionalities, any changes to the market standard, the market regulation, and also testing requirements and the time that is needed to achieve all of them. And also considering the lesson learned from US, moving then on to an implementation phase, delivering what is necessary in terms of changes that I was mentioning before, agreeing on an implementation timeline only after all these preconditions have been listed, shared, and agreed. So this is where we basically stand with the discussions in Europe and UK.
Thank you. Thank you. Now we have another question here, I think probably for Mirko. Mirko, could you expect any consequences within the FX settlement in CLS, that's continuous linked settlement?
Yes, there will be consequences for sure. Let's say that the industry is anticipated at least 20% of the current activity will be executed outside the CLS platform. CLS is studying the possibility of extending its submission cutoff of 1 hour or so, but the associated complexity and time difference with EMEA and APAC will not really match the T+1 May 2024 period. Because of that, the industry anticipated that an increase of the FX gross settlement, mostly with the associated custodian. As I was mentioning earlier, where security services is both custodian and FX counterparty, CLS is not needed as the payments are managed internally in our books, cancelling payment, reducing to zero payment risk and allowing our clients to execute and settle the effects without cutoff constraint. Therefore, as we already do today, we will be able to accommodate also T+0 transactions.
But what if I want to manage the FX myself? Would I still benefit from this upside?
Oh, yes. The only big difference between the two solutions is how the FX instruction is generated. Automatically for the auto effects, as I was mentioning earlier, or by the clients contacting also electronically one of our 6 local desks to manage their effects, continuing to manage their effects and continue to benefit from the no cutoffs and the non-settlement risks.
Thank you. Yann, this is really a question for you. We've heard about the United States, Canada, and Mexico. Are there other countries looking to move to T+1 in May 2024?
Thanks, Alan, for the question. I hope everyone has their passports with them. We're traveling quite a lot this morning. On March 6, 2024, the Argentina, which is our next stop, stock market announced that the implementation date for the reduction of the settlement cycle from T2 to T1 for the equities and bonds market would be May 27, 2024, aligning with Canada and Mexico. This change aims to align Argentina with the US, Canada, and Mexico market, which will also migrate in May 2024. BYMA, who is the stock market locally, has also announced that settlement on a T0 basis will remain available to participants without any change to their current process.
Okay, and then we have a question here. Well, it must be for Emmanuelle. It must be about affirmation processing. Can we, as an RIA, have a view on the timely affirmation rates?
Thank you, Alan, for the question. So, as we mentioned earlier, it is highly recommended for an RIA, Registered Investment Advisor, to obtain his own trade suite ID because it helps the RIA to keep track of its allocation, affirmation, confirmation. But not only, it also helps the RIA to keep track of its activity and the affirmation rates, because obtaining its own trade suite ID at DTCC give him access to a DTCC tool that is called ITP Data Analytics that will, in which he will find the affirmation rates. I'm not going to go into detail of the different access to DTCC and the different level of trade suite ID that the client can obtain. But basically, most of the subscription to DTCC, either through CTM, trade suite ID, of a trade suite platform or match to instruct, give to the RIA who obtain its own trade suite ID the access to ITP Analytics, where he can find the operational metrics, including its affirmation rates.
Okay, and then there's another question for you, Emmanuelle, about affirmations, about clients who have their own trade suite ID. Would BNP Paribas affirm using clients' own trade suite ID?
Yes, indeed, it's part of the model that we are proposing. If the client has his own trade suite ID at DTCC, we can continue to affirm the transaction on their behalf, but using their trade suite ID. For that, what is important is to update DTCC alert platform with the client trade suite ID in the field institution/broker ID, and to clearly identify who is going to be the affirmation party. And for that field, it has to be the agent. And like this, the client will see its transaction affirmed with its own trade suite ID, and BNP Paribas will do it for him. And as soon as the transaction will be affirmed, we will send a notification that the transaction was matched.
Thank you. Silvia, who bears the costs for late affirmation? Is it the broker or the client?
It's both of them. So when you say client, I mean, in the question, so it's the broker and the custodian as a DTCC participant. So both of these subjects bear the cost. So as a custodian, in our role of custodian, we will be hit by DTCC for the late affirmation cost. And this is what was mentioning before. So when it comes to additional costs, so because of late affirmation. So the first hit will be with the broker and the custodian. And then we could be having, you know, discussion on how and if this cost so will be passed on to the chain of custody.
Okay, and Isabel, here's a question for you. It's quite a complicated one. I hope I get it right. So it's for Isabel, and the question is, do you have a view on the CSSF Circular 0277 revamp and the CSSF position regarding cash breaches related to a mismatch of settlement cycles of sub/red VS? And is there an impact on the purchase and sales of EU UCITS funds in the US? Have you got that, or shall I read it once more?
No, I get it. Thank you.
You got it? Okay, it's quite complicated.
For the CSSF part, so we expect this circular to be published soon, and they informed in the ALFI conference yesterday that there will be a taxonomy on different breaches categories, and that the breach related to security settlement time difference will be identified as such, and the importance will be qualified accordingly. So we can expect some to the CSSF to have a specific attention and qualification for this situation, which is more technical than a real breach from the asset manager. So regarding the second question, I suppose that it is linked to the NSCC distribution of European funds. So, and if the T+1 will impact the funds, sell the subscription redemption coming from NSCC into European funds. So this settlement cycle is not defined by the local US practice, it's defined by the fund characteristic. So when a fund is distributed via NSCC via US brokers, the TA, the transfer agent, is defining in NSCC systems what is a settlement cycle. So today we already manage distribution via this NSCC solution of funds being from T0 for money market fund to T+3 for normal European funds. So this will remain as it is and will remain in line with the cycle of the fund, of the European fund itself.
Okay, Silvia, a question here for you. If a buy-side client is not using the DTCC for affirmation due to low volume trading, and instead instructs using the BNP Neolink system, will it be enabled? Will this be enabled for instructions to be made in T+1 in the UK morning time for US trades?
Yes, so Neolink is indeed a tool that a buy-side client can continue to use for submitting instructions. And this is the question is basically for a scenario where the affirmation is done by BNP. So BNP will be the affirming party. So in this case, the buy-side institution is not requested, to access the DTCC for affirmation. So this is one of the scenarios that my colleague Emmanuelle was mentioning before. So what is important is the time. This buy-side institution will be uploading instruction in Neolink for the instruction to arrive in the BNP ecosystem, meaning Swift, Neolink, and the other mean of transmission by the cutoff affirmation, which we said before, it is 8 p.m. Eastern time.
Okay, and then there's another question, I think, for you. Silvia, you mentioned an update on our SSIs on the DTCC side. Does BNP Paribas assist in this?
Yes, we do. Please kindly contact your client development representative, so your relationship manager, or your client services manager for these, part of the subject to be reviewed, because this really depends on the type of affirmation that you would like to put in place. So as you've seen, we have plenty of scenarios that could be put in place, and as such, the update of the exercise depends on the type of affirmation chosen by our client.
Okay. Emmanuelle, here's another question really for you. It's quite a long, complicated one, but the essence of it is it mandatory to send affirmations for US trades? The person who submitted the question thinks probably not, and they aim at not affirming, but instructing the trades on T+1 by 10 AM CET. And therefore they have the whole day in Europe to act if needed. They're aware of the higher costs, but due to the very low volume of trades, that's not really an issue for them. So is what they are proposing, is that possible?
Well, it's quite a long question. So to recap,
that was a précis of it.
Yes, it is mandatory for US brokers that are registered with the Securities and Exchange Commission to send affirmation by 9 p.m. On trade date Eastern Time to the depository trust company. So it is mandatory to affirm the transaction for US broker-dealer that are SEC registered. Consequently, the broker will expect you to affirm the transaction as well. So in a way, even though it is mandatory for the US broker-dealer, and if you are not a US broker-dealer, you can consider that it's not mandatory for you, the US broker-dealer will expect you to affirm the transaction. Having said that, it doesn't mean that if you don't affirm the transaction by 9 p.m., the transaction will not settle. It can still settle either through the nighttime cycle or through the daytime cycle. And so what I understand from the question, if you intend to send the instruction on settlement date, so in that case, it will settle through the daytime cycle of DTCC if all the elements match and if the positions, either stock or cash, are present. But the cost of settlement will be higher because DTCC will charge additional cost for the transaction that settle as a delivery order, either through the night cycle or the daytime cycle. So indeed, it will impact the cost of settlement of the transaction at DTCC. So I think I cover all the points that were part of the question. You have indeed. So I think that brings us to the end of the questions. How appropriate that we finish with the affirmation process. So thank you to our panelists for sharing your knowledge with us today. It's been informative. It's been very helpful. And thank you very much to our marketing team for putting all this together. It always works so well. Thank you very much for doing it for us. But most of all, we'd like to thank the clients for joining. Do get in touch with us through your client service officer if you want to talk more about T+1. Thank you.